I see that as an evidence of the pending stock market break. Now, we see technicals on the stock market, S&P 500, NASDAQ 100 in particular, which is the leader index, that are very dark, meaning when you look at the price chart of NASDAQ 100 or the S&P, you see this upward arcing price action. You can't really find anything that says, gee, if I drop here, I'm going to break something. It doesn't look like there's anything real obvious to break. Quarterly momentum of the stock market looks terrible. It has a floor that it is built, where if you looked at the quarterly momentum chart of the NASDAQ 100 in particular, you'll see that 3 times in the last 2 years, you've dropped the NASDAQ down to its 3/4 moving average, therefore on the oscillator down to its 0 line. And it's built a floor, meaning a structure, okay? If you break that structure, watch out. The last time I saw this pattern so clear, also 2 years wide, use of the 0 line, was in 1987. I caught the crash in 87 in a small way. I was a futures broker. It was 5 years before I set up MSA. And I was plotting quarterly momentum chart, and it looked exactly the same as the NASDAQ looks right now. And what happened was you were playing around your highs in the third quarter in price, but momentum had built this structure that it had used 3 times over a 2-year span. The problem was that 3/4 moving average gets adjusted every quarter. It's like a 200-day. 200-day gets adjusted daily. 3/4 doesn't change. Once every quarter, you adjust it. So it's like a big gear wheel. Okay. Right now, the NASDAQ 100's 3/4 average is going to vault from 17,500, which is where it held this quarter in the sell-off, jump to 18,600. And we're trading 19.9 or so right now. There's also some other levels before you even get there that indicate you're in the process of breaking. But if you ever go down to that level again, you will not hold this time. Now, does it have to crash? No, but it's highly likely to make a lot of noise if you go back down there. That's only 5% or so below the market. That's a sneeze. Whereas you could drop the market 5%, nobody would even care looking at the price charts. But momentum says you're dead. Now, at that point, suddenly the stock market would become a dynamic force, causing a lot of rethinking by asset managers, looking for, again, a better place to be. And they look around and they see T-bonds upticking and they see gold, obviously doing what it's doing. And they say, well, I'm not a gold bug, but stuff's behaving well, And 3 big managers I know of got into it and, they're doing well, et cetera. You get the point. So that's an asset category to watch because it could have an impact not only on money flow, but central bank panic, which they've already begun to do. They'll really panic if you break that market because when you break the stock market, the data points will suddenly go vacuum with the market. So if something looked marginal data point wise, economic wise, it ain't going to look marginal after that. And they'll go full throttle. So,
wow, so that really fits the narrative of asset managers. What feels right, and feels good, and what looks to be cool.
It's as simple as that. It's not great science. It's just this hurts, and I'm losing money as a portfolio manager. Therefore, I got to get into something that isn't losing money.